Hi, my name is MLEDDY. I decided to do my mortgage crisis assignment on the book All the Devils Are Here: The Hidden History of the Financial Crisis by Bethany McLean and Joe Nocera. There are three primary contributing factors of the mortgage crisis. These include credit default swaps, collateralized debt obligations or CDOs, and an overabundance of subprime mortgage lending. Those three are the main contributing factors, but the overall cause of the mortgage crisis is greed and unethical behavior, which was the primary focus of this book. A credit default swap allows one investor to swap the risk of their investment with another investor. These were critical during the time of the mortgage crisis because they were not regulated to the extent they should be. A credit default swap is like an insurance policy for bonds and mortgage-backed securities that investors can trade. Another cause of the financial crisis was CDOs, collateralized debt obligations, are options for investors to purchase. There are CDOs that are backed by collateral and synthetic CDOs that are not backed by any collateral, but are based on performance by already existing bonds. It was not just mortgages included in CDOs, but any kind of debt can be repackaged and sold in a CDO. Lenders provided loans to people they knew could not afford them. There were not enough regulations and buyers were confused about adjustable rate mortgages. Lenders could lock low FICO subprime customers into low interest rates in the early part of the loan and then make their payments unaffordable years later due to the hike in rate. One example the book used was the 2-8 rule, where the first 2 years had a very low interest rate and the last 8 would drive the customer out of an affordable payment. Almost anyone could become a mortgage loan officer who wanted to work long hours and sell. Loan officers were doing whatever they could to get their customers approved. These jobs were sales careers with minimal base salaries but had exuberant opportunities for commission. This career was appealing to those who had recently came out of school, high school or college. Companies attracted these people to work long hours but treat them well with parties, gifts, and other appealing factors to get them to work long days and sell mortgages. The book is titled All the Devils Are Here because it profiles several people that it feels are to blame for the mortgage crisis. Though several are mentioned, here are a few that I felt were necessary to highlight as they each represent a different piece of the puzzle. Angelo Mozillo knew how to run a business. He was not originally a believer in subprime mortgage lending, but he was persuaded by his peers to enter the market. Mozillo's ultimate goal was to have Countrywide remain the #1 mortgage lender. After all, he successfully ran the company for several years and made his way to the top. He eventually gave in to pressure to enter the subprime segment in order to remain at the top. Roland Arnall was like Mozillo in the sense that he knew morally subprime mortgage lending was not ethical. Arnall was a well-known philanthropist by helping those in need. However, he also made billions off those same people in need by selling subprime mortgages and making billions of dollars off of excessive interest rates of people who he knew could not afford them. Before reading All the Devils Are Here, I was unaware of AIG's involvement in the mortgage crisis. AIG is an insurance company who was a major facilitator of credit default swaps. Hank Greenberg had been in control of all AIG's business segments except in their financial products segment. The book talks about how Maurice Hank Greenberg was CEO at the time of the financial crisis and how he eventually took control of the financial products business and what a jerk he was to work for. The credit default swaps took place under his watch at AIG, and he was eventually ousted from the company for being unethical as it related to blue sky laws. Stan O'Neill was another devil per se as he drove Merrill Lynch, formerly a very risk-averse company, to one who sought more risk and embraced everything that came with mortgage-backed securities. O'Neill tarnished the reputation of the company and had even tried to sell to a larger bank before being expelled from his position. Goldman Sachs had long had a reputation for placing great value on their customers. They were known for their sound investment advice and the relationships they had with their clients. Under Blankfein's practice, this matter changed and the company was instead trading against their own customers. Goldman had long assured customers that their investments were sound and they were investing in strong, stable securities when they were truly investing in mortgages that would likely fail. This goes back to the notion of going and packaging several triple B related bonds and repackaging them to appear triple A rated. Goldman, under Blankfein direction, defrauded their investors and smudged their reputation. Franklin Raines is most known for manipulating the earnings of Fannie Mae as CEO. By overstating earnings, Fannie Mae appeared to be performing stronger than anticipated. This in turn allowed him and other executives to make more in bonuses and other compensation rather than sharing their true earnings with their investors. Brian Clarkson, like me, was born in Michigan. He attended a small school in Big Rapids called Ferris State University. He was known for being an intimidating leader. Moody's role in the financial crisis was that they were the ones rating the mortgage-backed securities and CDOs. Moody's was providing inaccurate ratings to appeal to investors despite knowing that these securities were made up of subprime mortgages. They rated most of the securities AAA, which was deceiving to the investors and not a true indicator of future performance. Alan Greenspan was the chair of the Federal Reserve who was known for pushing interest rates to an all-time low. He drove the interest rates down so low that people were attracted to subprime mortgages, allowing almost anyone to seemingly be able to afford a mortgage. He supported adjustable rate mortgages and watched as interest rates rose and home values declined, forcing Americans who could once afford their house payment out of their homes. This led to a number of people defaulting on their mortgage, which led to seemingly safe securities being defaulted on and the housing bubble as we know it. There are a few things the book taught me about future financial decisions. The first is that ethics will always prevail. These devils, mentioned on previous slides, thought that they were going to get away with something, but several of them were caught and forced to pay restitution and damages. Another thing I learned, as we are experiencing now, just because the interest rate is low doesn't mean you can afford a home. There are several factors to consider, including FICO score, job stability, future mortgage rates, and if it is an adjustable rate, assuring you can still afford your home in the worst case scenario. Another thing I learned is if it sounds too good to be true, it probably is. Americans learned this when we had teenagers and early 20s selling mortgages and living lavish lifestyles. I also learned a valuable lesson in sticking to your gut. Mozilla was initially against subprime mortgages, but he let greed and the opportunity to be the best fuel his desire for money and go against his original opposition to subprime mortgage lending. This concludes my review of All the Devils Are Here by Bethany McLean and Joe Nocera. Here is a citation to the book and the facts preceding this slide.